Welcome to this week's video where I discuss what I believe is important for individual investors to understand and know before they make their investment decisions over the next 5 to 10 business days. We're going to talk a bit about the Russia-Ukraine situation and how that's affecting markets. The Federal Reserve will meet shortly. What does that mean for markets if they were to raise interest rates? It is highly expected that they will. And lastly, Canadian bank stocks. We're right now in the midst of bank earnings season for our Canadian banks. How are they doing? Are these still good investment ideas for Canadian investors? Over the past week, I guess the world has been watching what's been happening in Ukraine and the effects that the attack on Ukraine by Russia is having on the rest of the world, not just the countries in that region. The stock market has pulled back a number of times over the past week and a half or so based on what's coming out, the headlines out of Ukraine or Moscow, or even headlines out of the United States talking a bit about what they're doing to help Ukraine during these difficult times. If you're an investor today, I think you can't help but to try to figure out what this means for your portfolio and also what it means going forward for new investment. In my opinion, these types of events tend to be very short-lived. Hopefully it will end in a peaceful way and everyone will get back on their feet shortly. However, during these times, I think savvy investors are in making acquisitions, buying on the dips, if you will. But I think buying on the dips at this time is a lot different than how it's been over the last few years. I think you want to be a lot more selective in the names you choose during this time, as some really good quality names have fallen just because things have gone the way they have in Ukraine over the past week. These companies are still producing good earnings. They still have great management, and their outlook going forward is still strong. So in my opinion, I think you want to use what's coming out of the situation in Ukraine as a selective buying opportunity. So buy on the dip selectively. I think you can be rewarded going forward over the next 6 to 12 months if you do so. The Federal Reserve will be meeting shortly, and it is highly expected that they will raise interest rates 1/4 point. Now, I tend to talk a lot more about the Federal Reserve than the Bank of Canada, even though it is expected that the Bank of Canada will also raise interest rates 1/4 point. However, the world looks to the Federal Reserve to set the monetary policy, and the rest of the world feeds off of it. I believe that if the Federal Reserve were to raise 1/4 point coming up shortly, that we could actually see the market rally in the face of 1/4 point increase, because it is doing what the market has already priced in. However, if the Federal Reserve feels it necessary to raise more than that, raise interest rates perhaps 50 basis points, I think you could see a market sell-off. So as an investor today, understand what the Federal Reserve is about to do, follow it, see what they do end up doing, and if it is 1/4 basis point, I think you can be a lot more confident that this market can move higher. So interest rates and stock market move higher at the same time. If the Federal Reserve ends up raising interest rates 4 times, 1/4 basis point each time, I think we can see a rally in the North American stock markets. So if you're an investor, don't be afraid of higher interest rates. I think they're long overdue and they should be expected. Over the past week or so, our major Canadian banks here in our country have begun to report earnings for this past quarter. I think their earnings have been solid. Nothing too exceptional, but definitely good quality earnings. I anticipated this because we saw our neighbors to the south, their banks report a similar type of quarter. We've heard recently that TD Bank has made a big acquisition. We've heard that CIBC is about to split their shares 2 for 1. So there have been a number of announcements that I believe have implications for how well the stock prices of some of these banks will do going forward. We haven't seen all major banks report earnings as yet, but I believe the rest of them will report pretty good earnings as well. So a question I get often by Canadian investors is, can we still buy Canadian bank stocks? Canadian bank stocks are at pretty much their all-time highs right now. However, going forward with interest rates about to begin rising, and interest rates probably rising another 3-4 times throughout this year, I think financial company stocks make a lot of sense. Canadian banks, Canadian insurers, these are the financial institutions that will benefit from higher interest rates. They'll be able to charge more for the loans they provide, Net interest margins will go higher, and this only benefits bottom line for these banks. So going forward, should you be buying all banks? I think you can buy a few selectively. I think Scotiabank is the one that pays the highest dividend right now, and the one that I think investors are looking towards to get that good quality growth with income as well. So banks can be and should be a part of a diversified portfolio for most Canadian investors today.